Good evening,
Good
everybody.
evening, everybody. Shall I start?
Ma'am, 1 second. Huh? So
Yeah.
sorry.
Mhm.
On behalf of Professional Development Committee of Western India Regional Council, the Institute of Cost Accountants of India, I welcome all of you for the webinar series for UPSC ICoAS preparation for newly qualified cost accountant. Today is the ninth session. Ninth session is on marginal versus absorption costing, cost volume profit analysis, decision making involving alternative choices. Our today's speaker is CMA Rashmi Mudgal ma'am. She is a practicing cost accountant. I welcome ma'am and I welcome all the participants. Now I request ma'am to kindly start the session ma'am, please.
Thank you so much, Pujanka.
Thanks ma'am.
Uh, Thank you so much. Thank you for the opportunity. Today is your eighth session, but mine is second, and I don't have that much experience into webinar beforehand, before yesterday. But I tried to give a good presentation yesterday, but I was experiencing a lack of interaction. Today, I tried to put more problems here and tried to put more approach which is more practical. And I hope we can connect over any questions or any interaction during the presentation. And let's start today about the costing techniques. Costing techniques are mostly taken care with the service as well as manufacturing industries, but we actually go in this era and the time when we are living in India, we are actually appreciating Make in India, and somewhere we are thinking to make the products at a lower cost and maximize the profit. How can we achieve? What kind of methods we have taken? Yesterday we have discussed the methods. Today we are going to discuss about the techniques. So I'm sharing a slide with you. Today we are going to discuss about the marginal costing. Marginal costing, how it comes, what is the difference, and how it is different from other things. For example, the agenda for today is marginal costing as well as absorption costing. What is the difference between the absorption costing and marginal costing? As well as we are going to discuss the CVP analysis. CVP analysis is a good number of alternatives when we are going to discuss about margin of safety and break even point, desired profit, and other techniques. Cost volume profit is actually going to give us a clearer picture with the diagramic presentation, so that we will be able to make an informed decision, and it will give us a strength to make strategy as well as to take the decision which can improve the cycle of manufacturing, as well as it will be a cost effective decisions, so that we can increase our profit. The main motive is to increase the profit, and there are examples also with this presentation. So now we are talking about the marginal costing. The practice is commonly used in manufacturing industries. The company try to achieve the economic of scale. The marginal costing is somewhere a managerial costing where we actually see if I decrease or increase one or more unit of output, my final output, if I increase or decrease, what changes it brings in my profit or in my revenue. Okay, so how marginal costing comes into the picture. It is mostly depend upon the variable constraint. For example, if I am making one unit of anything, what I am using a material, what I am using a labor, what is the direct material to this product if I'm manufacturing it in one, or quantity maybe additional what I am manufacturing in the regular business. So this is more about the variable costing rather than the fixed costing, because fixed cost is remains same. As the assumption of marginal costing, we assume that fixed cost will remain same at all the time, at any level of manufacturing when we are going for the, and marginal costing is somewhere we can see it is a short term period costing. Why it is short term period costing? Because here we assume that fixed cost remains same and we are increasing the sale and we are increasing the output. But at after some times, if I wanted to increase output after a certain limit, I need to make a investment into fixed cost because I wanted to increase the capacity. So here manage marginal cost is for the short term. What they do, marginal costing enable managers to make decision on the resources allocation, optimizing the production, operation, control manufacturing cost, plan budget and profits, etc. It consider expenses incurred at each production stage except for the overhead pricing. So practice is for the manufacturing. What are the some key takeaways we are going to take from here? Firstly, marginal costing is the increase or decrease of the overall cost of production due to change in the quantity of desired output. We are already producing some number of quantity and we have already set some capacity that we are working on a 60%, 70% of the capacity. If I'm getting another order for the 10% more capacity or maybe for the 10,000 more product, what will it impact? My variable cost is taken care by the marginal costing. It can be used for resource allocation, optimizing production, streamline the operation, control manufacturing cost, plan budget and profits, and so on. This is more of a cost, it is a more of a method of managerial decision rather than cost control. So we can see here it is a technique of the costing where management can take the decision. It is less of the controlling technique. We can use it into the controlling technique, but more we use for the management purpose. Next is, in the most cases, variable cost influence the marginal cost. As we can see, I have already told that it is for the short term where fixed cost remains same and marginal cost will increase because of the variable cost only. Because I am producing more product, I will definitely gonna need some direct material and labor for the production. So this is the only part I will calculate for the marginal costing. As I say, I have already utilized my fixed cost in the previous production. And when the company's marginal cost equals to its marginal income, it maximizes the profit while setting up the selling price for the product and services. Where I'm saying that my marginal cost is equals to my marginal income, then I am getting the maximum profit. How it happens, we can see it how marginal costing comes into the picture. Company receives an order and decide to finalize the resources that we need to produce this and what kind of resources I need. For example, we need money, we need labor, we need consumables, we need raw material. And when I am decide the finalizing the resources, then I actually received an extra order of the same product. So now I have already decided, I have already computed my profit for the order which I have already previously decided. Now I am receiving another order and I am adding only the variable cost as I have already allocated my fixed cost to the beforehand to the previous production. Cost of production increase or decrease, that cost is increased because of the order I received is my marginal costing. For example, I can see here if the total number of unit produced is 800 and the total cost of production is 12,000. In case of one unit additionally produced, the total cost of production may become rupees 12,010. So here I can see one unit has increased and the amount in the cost of production increased by rupees 10. And again, in the second scenario, the contingent upon the production quantity is decreased by one unit. So the total cost may come down to the 11,990. Thus, the change in total cost is by rupees 10. In both the cases, increase and decrease of the quantity of production, I can say that the marginal cost is rupees 10. So is there any problem till now in the marginal costing? Thank you, Divya. Okay, now I'm going further for again going to know what exactly for the better presentation and better idea. I'm going for a little big example. Let us assume that a pen named Parker sold by Lotus Limited for 14,500. One pen is sold at the rate of 14,500. The direct material cost per unit is 3,200 and the direct labor cost per unit is 4,100. Variable production overheads cost per unit is 1,320. Fixed or overheads per month are 1 lakh rupees and the budgeted production level is 100 units. So we have already in mind, we have planned that 100 units of product we are going to produce. So we can see there key sales price is 14,500, variable is direct material 3,200, direct labor is 4,100 and variable overheads are 2,320. Total variable cost is 9,620. Contribution per unit is 4,880. So we can see here contribution like profit before my fixed overheads is the amount 4,880. So now I can see contribution of 4,880 initially recover the fixed cost of 1 lakh rupees. So firstly I need to recover my fixed cost, then I will think about the actual profit. But before fixed cost, I can say that I am in the contribution. I am having a profit of 4,880. Budgeted production is 100 units. So total contribution is 4,88,000. Thus the profit will be contribution like 4,88,000 minus fixed cost 1 lakh rupees will be my 3,88,000. So if there is one pen is produced, cost will be increased by the variable cost 9,620, which I have calculated in the previous slide. 9,620 was my variable cost, which will increase if I will increase the one quantity of my output. This will increase. Okay. Next, I'm going for the absorption costing. What exactly the absorption costing? I have felt in the marginal costing that we are considering only and only. We are considering only and only variable costing. But into the absorption costing, we are looking for the fixed costing also. It both are good for the manufacturing industry, but in absorption costing, one approach that used for valuation of inventory as well as calculation of cost of production of the company, where all expenses incurred by the company are taken into the consideration. It includes direct indirect expense incurred by the company during the specified period. Main idea and intention behind using absorption costing for the costing purpose is to imply that a product when produced absorb both and fixed and variable cost up to a certain extent. So we can see here that product has been produced without, we can't say this thing, a product has been produced without any fixed cost. So we are allocating the fixed cost. We accept the marginal costing method as per the contribution, but in absorption costing, we actually allocate the fixed cost also over the good. It is very common method used for the business, especially in manufacturing industry, and in the way of able to determine the cost of individual product and services. It does not depend on the fact that the product has been sold or not, or it's still lying in the storage or inventory or finished goods or ready to be sold. It does not rely on these facts. It is taken into that what has been produced and all the cost need to be allocated to this production. We don't believe that variable cost will be the problem here. Okay, so why absorption? What is better for the company? It is totally depend upon the management and what kind of industry they are in. For example, if I talk about the practice, I am doing a practice, so I don't have any variable cost. I only have fixed cost where I need to pay the rents, I need to pay the annual maintenance, I need to pay. There is small things which you can say a direct material, which is normally a paper. But if I say the expenses are more fixed in the services, as they can come after 6 months, 7 months, but I don't have anything in my pocket to give them physically. So in this case, I cannot ignore my fixed cost. And according to the industry and dependency on the variable cost or fixed cost, we can judge there that what is best for them. Is this marginal costing or absorption costing? It's totally depend upon ki how the industry we are going and what is the management decision. What is the difference between the marginal costing and absorption costing? So firstly, to marginal costing, consider mostly variable cost. Mostly means if I am increasing a small number of units in my production, there could be a possibility that there is no fixed cost will increase. But if I am going to increase my output with a significant number of increase, I need to make some fixed deposit or maybe some fixed cost increase by some percentage. And in absorption costing, consider variable as well as fixed costing. This is a major difference. But yeah, there is a meaning also which we can go further where marginal costing technique assumes only variable cost is a product cost. But in absorption costing is a technique that assumes both fixed cost and variable cost as a product. What is all about? Variable cost is considered as product cost and fixed cost is assumed as a cost for the period. But in the absorption costing, both fixed cost and variable cost are considered in the product cost. Nature of overheads, again fixed cost and variable cost both are taken into the overheads. Overheads in the case of absorption costing are quite different: production, distribution and selling it, administration overheads. This kind of cost distribution. What is the profit calculation? Here we actually calculate profit volume ratio, which is basically contribution divided by sales. But in the absorption costing, fixed cost also consider in the product cost, and that's why profit is reduced by the significant number of the fixed cost. Okay, what they determine marginal costing, the cost of next unit, what I will, if I am producing one more unit, what will the cost? That is the motive of the marginal costing. But in absorption costing, we actually divide it from the cost of production, so we can get cost of each unit. Opening and closing stock doesn't affect the cost per unit in the marginal costing. Since the emphasis on each unit, change in opening and closing affect the cost per unit in the absorption costing. Most important aspect is contribution per unit, but contribution is equals to sales minus variable cost is my contribution. But in case of absorption costing, we actually go contribution minus fixed cost net profit per unit. So purpose, what is the purpose for the marginal costing? It shows forth on emphasis on the contribution of the product cost. We believe this is a period cost, the fixed cost is a period cost, and it will recover in the period, maybe after some time. But if I am not getting this order or not going to get this order because of the fixed cost, I will not be able to get my even my variable, or maybe I'm not able to get the in volume sale target. This is more of the volume perspective to show fourth hand accuracy and treatment of the product cost. प्रोडक्ट के अंदर जो भी आपका accuracy fair treatment आएगा वो यहाँ पे आएगा. How it is presented by outlining the total contribution, but most conveniently for the financial and tax reporting, absorption costing is taken care, because in the tax I wanted to pay less tax, and if I wanted to pay less tax, I will definitely gonna deduct my fixed cost also from the profit. Let's take an example today. Firstly, a company produce a single product boost. Capacity utilization is 50%. Now I can see the capacity utilization is 50%. So it means sales and production unit is 400. And if I am increasing it, by the significant number, I can increase it up to the 800 at the capacity with the same fixed cost. Okay, and variable is 3,20,000. Fixed is 1,60,000. It is a production cost. And selling and distribution variable is 1,60,000 and fixed is 2,40,000. If there is an offer of 400 more unit, what should we decide? So this decision we can take by the Excel I have made. Hmm, sorry, we can do this here. As I come, I have given the sales. Firstly, if I wanted to increase the, this is my sales price. What is my sales price? 8 lakh. Okay, this is my sales price. If I come to the production overheads, this is my production overheads. And if I go to the variable only, variable production overheads, if I go, this is amount of 3,20,000. Okay, and now comes to the selling and distribution overheads. Again, variable sale and distribution expense. This is 1,60,000. So we can calculate here contribution by sales minus variable cost. If I minus, this will be 3,20,000 will be my contribution. So this is my contribution. And what is my fixed cost? If I go again for the fixed cost, production overheads. So this is my 1,60,000. and fixed selling and distribution. It is 2,40,000. So if I consider the profit here, it is loss basically. The profit is a loss. So I can see here that I'm making loss in the overall, but in the contribution, I'm making profit in the 400 units, in the 400 units. So I can see if I calculate this, what is the price for the per unit price if I calculate. So this is 2000. Okay. And if I say my variable production overheads were 400 per unit. So I can see here that I am making a loss of 200 rupees per unit in the case of 400 units of production. So in the second case where I am trying to achieve 800 unit, I will definitely gonna increase my sale by this significant amount where I am getting double of my sales. Again, in this scenario, again, I will come and see variable production head definitely gonna increase by the double amount, because obviously if I am increasing my production, I need to increase my variable cost. Again, for the same, selling and distribution expense will increase by the same. Now I'll say if I'm going to make where sales minus variable cost, my contribution has increased by the 50%, whole 100% has increased because I have somewhere increased the quantity in double, but my fixed cost will remain same. My fixed cost will remain same as it is, and the which was the loss at the time of 400 unit become a profit of 2000, sorry, 2,40,000, 2,40,000. So I can see here the so I can see here my variable cost does not increase as it is same at the time of 400 unit. Per unit, it does not increase, but at the time of fixed cost, it has decreased by the drastic 50% of total cost. So I can see here that order I can take. If there is an offer of 400 more unit, what should you decide? I should decide yes, because there could be possibility that I am able to reduce my loss and make profit as well. So in this scenario, I can see here this at the time of 800, I'm able to recover my variable cost as well as my fixed cost. But in the scenario where I'm making only 400 products, I'm not able to make profit. Either I'm going into the loss. Okay, so this was the actually computation where I am looking for the decision making by the marginal cost. So is there any questions? Yes, you will get the presentation. Is there any questions?
Ma'am, your voice is breaking. So you can just put your video off so that I think that will be better for better communication.
Okay.
Hmm.
Are you able to see the PPT?
No, ma'am. Currently, different screen is being shared. You have, I think, your PPT. Yes, ma'am. We can see now.
Okay. Is there any question till now?
Ma'am, if a question comes that, uh, for example, if the total capacity is 400 and
Hmm.
the sales and all the figures are given at 40% utilization.
Okay.
So to get the 100% utilization, to be divided by 60%.
If capacity is 100% is 400, you are saying this is the whole capacity. 400 is full capacity.
No, I'm just telling that if the sales figure in total basis, it is given that current capacity is 40% utilization, having
Yes.
a sales production unit of 400. 40% is
Hmm.
400. Then
Yes.
then to get the 100% utilization, you have to divide it by 40% or 60%.
Divided by 40%.
Okay, and the fixed elements also, fixed cost also will be divided by 40%, or that remains the
No.
same.
Fixed cost remain the same.
Okay, okay. Only the variable portion and the sales
Only
portion will be
variable
divided
cost
by.
will change because already I have spent so much. Already I have invested as a fixed cost, but variable will definitely gonna change because of raw material and labor charges, which
Okay,
I
yes,
need
and
to.
the fixed will remain the same with the whatever is the
Yes.
capacity utilization.
Yeah, if I
Yeah,
am
thank you.
increasing the capacity in this scenario, the fix will change. But if the capacity is 100%, like 1000 product, as your example says,
Yes,
the
yes.
400 product is for 40%. So definitely 100% will be 1000 product. If I'm getting
Yes.
a order of 1200 products, so I need to increase the capacity, then fixed cost will
Yes,
change.
that is we are increasing the capacity, and that on that basis other cost, every cost will increase in a different
Yes,
proportion.
yes.
Yeah, thank you.
Okay. Any other question? Okay. Let's move to the another perspective, where is the cost volume profit. It actually a very good grip. If I come to the practical approach, this is the best thing because marginal will change, the even variable cost changes on the daily basis. But cost volume profit is somewhere which we make for the budgeting as well as we somewhere reach, sorry, okay, we somewhere reach for the decision making with this method. What is the desired profit I wanted? What is the break-even point? These are the techniques we take care in the cost volume profit. What exactly the cost volume profit is, basically, firstly I need to think about what is my cost, what is my volume, what is my profit. Volume is the output. So PVP analyze actually helps management to finding out the relationship between cost and revenue to generate the profit. So I can see what is my revenue, what is my sales, what is my cost, what is my profit. This is the actually basic concept for the cost volume profit. The volume of sale is dependent upon the production volume. What is my capacity? What is my bottleneck? What I need to reach at the what sales, what demand is there. I need to see this, which in turns into relate to the cost that are affected by the volume of production, product mix, internal efficiency of the business, production method used. Okay, so cost volume profit looks at the impact on the operating profit due to the varying levels of the volume. So if I am producing 400 products, what will be my profit? If I am producing 600 products, what will be my profit? If I'm making 800 products, what will be my profit? So this different scenario makes a very good Excel as well as a very good presentation here. What exactly the cost volume profit analysis? Firstly, cost volume profit analysis affect the changing cost on profit figures of a firm, helps find the volume of the unit to sell the cover the cost. So here we go ulta. Here we go ulta. Or we somewhere do the back calculation that if I sell this, do I get my profit or not? In the first, we used to see the sale minus cost equals to my profit. Now I go with the profit that I wanted to earn this much of profit. What should be my volume? What should be my cost? This analysis allow businesses to identify break-even point also, different sales volume where they would end up covering the differential causing due to the change in the fixed and variable cost. Okay, as well as they enables established relationship between the cost, volume, and product and profit margin as well. So here what happens, I believe these three interrelated things are taken into account at every aspect. In the marginal costing, we are actually taking only the variable costing and contribution. But in the cost volume ratio, we actually look after the profit first. Then we go to the volume and then we go to the profit. So here what happens, if I go to the CVP analysis, there is a pictorial form which we will create also in the Excel here. So they actually make a relationship. How they make a relationship? They actually go, if here in the picture you can see my fixed cost will remain same. My fixed cost will remain same at every number of unit of sale. If I'm selling a one unit, I need to pay the rent of one month. Whatever happens, I need to pay for the management salaries also. That will be also fixed. Whatever, only one unit if I'm selling, I need to pay the interest to the banks, whatever machines I have invested in the company. So fixed cost will remain at every level of production or every level of product sold at. So this is my fixed cost which will remain constant. Next is variable cost. Variable cost will definitely gonna increase whenever I am producing the good. So it will increase as my sales will increase. So total cost will be the addition of variable cost as well as fixed cost. So at the point where my revenue and total cost intersect, this is the point where I say that this is my break-even point where my total cost is equals to the total sale, so I'm not getting any profit. It will be covered in another slide in the different way, but I can show you this example where fixed cost is 4 lakh. Even if I'm producing 1000 product, 20,000 product and 40,000 product, my fixed cost will remain same. But in variable costing, there is a 10,000, 2 lakh, and 4,000, 4 lakh. And if sales is as I can see here that the selling price is 300. So sale is 30,000, and in the 20,000 units it's 6 lakh, and in the 40,000 it's 12. So what I did, I made it into the Excel form where this is the scenario where I can see the 30 rupees is my selling price and 10 rupees is my variable cost. So I have calculated as per this. So now what I will do, I will make a chart with this. So in this chart, if you can see, this is my fixed cost, which will remain even in the first case when I have sold 1,000 product, in the second case when I sold 20,000 product, and in the third case when I sold the product which is 40,000. So this will remain same. In the variable costing, if I see, the variable costing will continue, and total cost जहाँ पे मेरा ये एक मेरा मैप बनता है जिसके अंदर I'm able to see that my cost, my revenue, as well as my profit will come to a point when I can see a pictorial graph, as well as I can see where I can beat my fixed cost, as well as I can see what profit I can make out of it. So this was a pictorial graph of CVP analyzing. I will share the Excel with you at the end of the session because I am taking the job costing, CVP and other also in the same Excel sheet. I will share it in the last so that you can get all the problems in one Excel. Okay. Next, I come with the importance of CVP. Why we need CVP? Why actually I need the CVP? I have already read job costing, batch costing. I have already read absorption costing, marginal costing. Why I need CVP? So I can see this is a clear and simple understanding of level of sales and requirement of a business to get a break-even point as well as to make a profit. It is helpful for business to determine the level of sales to reach targeted income. It helps also to understand the difference cost at different level of production and sales to forecasting the profit and loss. Business analyze during recession time the comparative effect of shutting down or the business or the continuing the business, so that if I am getting loss, I'm not able to recover even my variable cost, then I need to shut my business down. But if I'm able to recover my variable cost, there could be possibility right now I'm not able to recover my fixed cost. I can go and think about the CVP, that what volume I will be able to invest my money or not. How do I need to change my plan?
There is another participant who has to unmute, who has to mute him. Naresh. Naresh, sir, please mute yourself.
Okay. The effect of change in fixed and variable cost help management decide the optimum level of production. So I can decide what would be the optimum level where I am making the best profit. Because after one point, there is a loss because I'm not able to sell the product. It will increase my storage cost and it will turn my profit into the losses. So I need to get a optimum quantity which I need to sell. CVP analysis help to understanding the relationship between the profit cost and one hand on the volume. It is useful for setting up the flexible budget. If this happen, what will we do? If this happen, what will we do? This can be done only by the CVP. But there are small things which we need to think about, which we need to think about that what are the assumption we are taking into the CVP. So firstly, we are taking the assumption that changes in expense only occur because of the change in activities. But in the real life, the expense can be changed by the force of market, by the force of consumer behavior, by the force of competition also. So these are also change because of many factors, but here we are taking only activity level. In organizations sell multiple products, then they sell them into the same mix. So this is not also a thing that we will always say somewhere sell the same mix. We can change it. If my demand for pen is different than the pencil in the starting, but now the pen is over, you can say the demand is more than the pencil, then I will definitely gonna change the mix of my production. Okay, the sales price per unit remain the consistent. This is not also there. If someone is giving me 400 quantity order, they will definitely gonna change the price also. They will ask for to reduce the bulk order pricing. So this is also there. Variable cost per unit stay consistent. This is also assumption, because if I am buying quantity, a double quantity, if my order increase, I will definitely gonna bargain from my vendor just to save myself small amount, so that the variable cost definitely gonna change. What other calculation does CVP analysis involve? How to calculate CVP? What actually calculation I need to do for my cost, volume, profit analysis? Firstly, I need to see the contribution margin ratio and variable expense ratio. What is my contribution ratio? What is my variable cost ratio with the profit or with the quantity I'm selling? Break even point, where I'm not able to make any profit and loss, where I'm able to recover all my expenses, variable as well as fixed. Change in the net income. If I wanted a income, and if I'm changing it to the totality, if I wanted to increase or decrease my income, what will it impact on my volume as well as on the cost? Margin of safety. What is the margin of safety? Margin of safety, basically it is whatever I have earned above my fixed cost is my margin of safety. Where I feel comfortable, it is my margin of safety. Degree of operating leverage. Degree of operating leverage. Here I see what is my capacity, what is I am utilizing, what if I can work on the 60%, what if I can work on the 70%. This is not key, I will work on my 100% capacity only. But if there is no demand, there is no sale, then how could I am able to operate on 100%? If I am operating on 100%, it means I am increasing my inventory, and increasing my inventory will cause increasing in my storage keeping cost also. So here what happens, the CVP analysis involve these 5 factors. I am going to discuss it one by one in the slides. First is the contribution margin ratio and variable expense ratio. What exactly they? It is important for the contribution margin to exceed the total fixed cost for the organization to generate the profit. So I need to see that it can exceed the my total fixed cost. The CM ratio and variable expense ratio are helpful in organization to evaluate how significant variable costs are. In general, the contribution of high contribution margin ratio and low variable expense ratio suggests the product required low level of variable cost. So these are the formulas. What happened? Contribution margin ratio is sales minus variable cost. That means sales minus variable cost equals to contribution. So we can see this thing, contribution divided by sale is my contribution margin ratio. Variable cost ratio is variable cost divided by sale. So I can see here my variable cost is 10% off, 20% off, 30% of my sales price. So I can see that 80% I'm earning, I need to recover it from the fixed cost, I need to recover it from the contribution only. So this was my contribution margin ratio. Very easy to understand, very normal. People actually say that 10% is my profit right now. I buy it from 8 rupees and I sell it for 10 rupees. They don't consider any fixed cost and anything. They just work on the contribution in this ratio. Next is break even point. What is the break even point? Where organization is not earning any profit as well as there is no loss to the company is the break even point. So we can say dollar or in organization may express a break even point in dollar or unit. In dollar, the BEP present the amount sales required by the company to generate its production cost. So here we can see dollar for dollar. Dollar for dollar means if I have taken a dollar and I sold it for a dollar, it means I have not made any profit in this scenario. So it is also taken care where fixed cost and variable cost both are fixed cost and variable cost both are recovered at the point it is the break even point. So we can see in the formulas fixed cost divided by the contribution ratio is my break even sales amount that I need to generate from in totality. And if I wanted a unit where I wanted to know how much unit sales I need to do to get my break even point. So I will divide my fixed cost by the contribution per unit. This was my break even point. What is the break even point? It can be explained further here. The contribution margin represent the revenue required to cover the fixed cost to contribute its profit. So here what chart I have already made here, this is my fixed cost. This line, this parallel to the horizontal where the units has been sold, this is my fixed cost. This is my cost. This is my total cost. Now I comes to the revenue where I am getting a profit after the point where the cost is intersecting with the revenue. So on this point where my cost is equals to revenue, this is my break even point. But break even point is taken for the only for the profit earning purpose. It is not measure for its repayment of debt or how long the repayment will take complete. So break even analysis is a tool used by the businesses and the stock option traders. Break even analysis is essential in determining the minimum sales volume required to cover the total cost. It helps businesses choose the price strategy and manage cost and operation. In stock and option trading, break-even analysis to find the minimum price movement. Okay, the contribution margin represent the revenue required to cover fixed cost as well as contribute to its profit. Profit comes after the break-even point. When I have achieved the break-even point, then only I can earn the contribution. So in the next point, why it is necessary, why I am studying it, why it is necessary for the management or for the decision making. So I am looking for the pricing. Firstly, I need to see the pricing. If I am able to get the more pricing, then I will able to get break even. If my price is higher than my cost, then I will be able to get my break even point earlier than the more units of the sales. Okay, so So business get a comprehensive perspective on their cost structure with their break-even analysis, setting the prices for the product that cover their fixed and variable cost and provide a reasonable profit. For example, if a vendor say I am buying it for the 8 rupees and selling it for the 10 rupees, my 2 rupees is a profit. No, the 2 rupees is a contribution. Now I have to see that how many units I'm selling to cover my fixed cost also. So when I am setting the price, I need to consider my break-even point so that I can recover my fixed cost also. Decision making. Decision making for what? Do I need to expand the capacity? Do I need to increase the production, or I need to business shut down, or I need to run the business, even the surrounding those activities से भी मैं कुछ भी जो भी decision लेना है that I need to take कि new products and services need to be launched or not. Is there any capacity we need to increase? Is there any variable product mix we need to recall? These decision making are taken with the help of break-even analysis. Cost reduction. Cost reduction, what happens? Cost reduction, break-even analysis help the businesses find areas to reduce cost to increase profitability. This is also there. Performance metrics, break-even metrics, analyzes the financial performance tool to help the businesses ascertain where they are achieving their goals or not. Are they able to make a profit or not? Are they even able to recover their fixed cost or not? So this break-even analysis give them a clearer picture for this. So we are going to solve one problem with this. Here it is. And it will cover small things also from the further slides we will discuss, but I am taking this full-fledged problem where you need to calculate PV ratio, which I have already told you that the profit volume ratio, contribution volume ratio, break-even sales with the help of PV ratio, sales required to earn the profit of 4,50,000. So here I can see that I have a desired profitability where I wanted to earn at least 4,50,000 of profit. My fixed expenses are 90,000. My variable cost per unit is direct material is there, direct labor is there, direct overheads are there. Selling prices per unit is 12. So I am taking Excel again. What is my sales price? If I say my sale price is 12. Okay, my variable cost, I come to direct material is 5. Direct labor is 2. And direct overheads is 100% of the direct labor. So it is 100% of the direct labor. So I can see my total variable cost is 9 rupees. So my contribution is sales minus direct variable cost is rupees 3. So if I wanted to calculate my PV ratio, my PV ratio is contribution divide में, that is sales. That is my formula for the PV ratio. So I can see my contribution is 3 divided by 12 is my sales. This is the 25% is my contribution sales. In the scene of break-even sales, I need to calculate fixed cost divided by PV ratio. So my fixed cost was, if I recall it, fixed cost is 90,000, is 90,000. So I can see here is my fixed cost is 90,000 So I will say 90,000 divide by PV ratio is 25%. So my break-even sales will be 3,60,000. 3,60,000. So for the profit of sale, we will cover in the next slides, where we will come back to the same problem where I require to make the profit of 4,50,000. Okay. So is there any problem till now? Thank you so much. Now comes to the next page, change in net income. That what I am saying. In the previous scenario, I wanted a profit of 4,50,000. Again, in the change in net income, how to get a desired profit or targeted income. What happened if I wanted this much profit? How much volume I need to sell? Organization may use their net income target or sales performance target to assess how they may affect one another. It may help them better understand how many units they need to sell to make profit as per their requirement. The formula for this is fixed cost plus desired profit divided by contribution margin ratio. Or we can make it into the sales per unit so that we can get the volume of the unit. So in the last slide, I have asked that sales required to earn profit of 4,50,000. So in this Excel, I go, if I wanted to make a profit of 4,50,000, I need to see fixed cost plus desired profit divided by my PV ratio. Okay, so this is the formula for the desired profit. So now I will come to 90,000 plus my desire was 4,50,000 divided by PV ratio is 25%. So I need to make a sale of 21,60,000. So if I go to here, if I am going to make the profit per unit, so they are asking me if I'm making a sale of 21,60,000 and the price is 12, then you can see here that per unit price is given, but unit was not. So I need to make the unit 1,80,000. So if I'm selling 1,80,000 for 21,60,000, and my variable cost will be 5 multiplied by 1,80,000 units. So I can see here and this will be my direct labor. This will be my direct overheads. So my contribution will be this minus variable cost all. So my contribution is 5,40,000 total, and my fixed cost is 90,000, as I said. And my profit becomes 5,40,000 minus 90,000 is 4,50,000. So my desired profit can be achieved with the sale of 21,60,000. Is this clear? Okay. So next I come with the next slide with margin of safety. Margin of safety, it helps the organization to better understand the variable may affect their profit. So what they do, they may beneficial to calculate if the organization thinks a potential decision may be risky and it's attempting to discern whether the decision is worth the risk or not. But exactly the formula for the margin of safety is actual sale minus my break-even sale. I can calculate it with another problem. Here, to calculate the margin of safety, subtract your break-even point from the revenue. So for example, if a company is made rupees 2 lakh in the sale within a break-even point of 1 lakh, they have a following margin of safety. So sales is 2 lakh, break-even sales was 1 lakh. So margin of safety is 1 lakh. Very easy concept, very easy, but how to improve it? Why we need to read it? So we can increase or decrease the margin of safety by the taking only two steps. We do have only two steps. First is reduce the cost and second is increase the revenue. It will work you at any time. आपको ये charm की तरह work करेगा that all the profit can be increased by increasing the revenue and decreasing the cost. And decreasing the cost, what includes purchasing infrastructure as a service instead of buying it outright, improving productivity to create more units of the same resources, removing the products and services with the lowest profit margin, and updating the payment infrastructure. Okay, and increasing revenue will include increasing the sale price. We can simply increase 1 rupees of the sale and this will increase my profit by rupees 1. And in the if anyone has seen the podcast of Zomato owner, he has told that I'm getting a profit of rupees 1 or 2 per order, but in the mass it becomes in the crores, the profit becomes into crores. So if I am increasing a simple 1 rupee from the sale price, this will definitely gonna improve my profit. But I have to see that increase my sale price can somewhere affect volume of sale because people can move to the competitor. Implementing a new pricing model, you can implement a new pricing model where you can somewhere say that buy one get one free, or maybe if you buy in bulk, we will give you this amount. If you are buying 10 products, we will give you 20% on the 11th product. So expanding your market, you can expand your market. Firstly, you were selling into only the metro cities like Delhi, Mumbai, Chennai. But in after some time, you wanted to improve, you wanted to expand your market. You started selling it into the Gujarat, maybe into Rajasthan. So you have somewhere pushed the territory and expanded your market. Definitely, it will increase your volume and it will definitely going to increase your profitability. Updating your payment infrastructure. How the payment infrastructure, you used to ask people to pay us after 30 days. You make infrastructure where you can ask them to pay within 15 days, or maybe via some cycle where you need to pay less commission to the bank. You can decrease that also. So that was the margin of safety. Here what happens, margin of safety comes with only after the fixed cost recover. Only after the fixed cost recovered. Is there any question in this? Okay, let's move further with the degree of operating leverage. What is the degree of operating leverage? What they are saying, if I will change in sale, it can be amount, it can be volume. If I am changing in the operating leverage, where I am somewhere doing the change in my capacity utilization, it will definitely increase or decrease my income. So it is interdependent on each other. Higher degree of operating leverage indicates a small decrease in the sales may cause a large decrease in net income and profitability. This ratio measures the sensitivity of the company's operating income to its sales. What happens if 1% I have increased the price of, as we can see here, the two competitor is there. One is Coca-Cola, one is Pepsi. A small change, maybe in the quantity or maybe in the product pricing, will definitely gonna impact the market, because people will move easily to the competitor. Definitely gonna move to the competitor who is selling us into the cheaper price and better quantity and quality. So in the operating leverage, we can see there is a dependency of a sale to the operating income. How can it be calculated? We actually see the contribution margin divided by net income. This will become our degree of operating leverage. This was our five. This was our five calculation of CVP analysis, which we have discussed. First was contribution margin, which we was the contribution divided by sales. Break-even point, where the my total cost is equals to my total revenue. Change in net income, where I wanted a desired profit to be earned with the definite number of sales. Margin of safety is the feeling of safety, where I am able to recover my fixed costs. Contribution minus fixed cost is my margin of safety. Degree of operating leverage is the place where my in output, my sales is totally depend upon the profit. So if there is a little bit change in the sales, it will affect my total income. So these were the five factors which we need to see in CVP analysis. The CVP analysis we have taken care, but there are some limitation. There are some limitation of CVP which we are going to discuss. Till now, is there any question in these five? Okay, I assume there is no problem. Okay, so I come to the next slide, that is limitation of cost, volume, profit analysis. What exactly we have taken care that how the cost and volume and profit are interrelated. But there are some limitation. We can't sit. There are some limitation how it works. Firstly, the limitation comes with CVP. Firstly, it assumes that variable cost and fixed cost both will remain same, but this is not the case. The variable cost also changes with the time, with the order, and the fixed cost also change with the time and order. However, some costs may be semi-fixed. For example, there may be facility that charges a fixed base rate for using this facility or variable charges based on the how many hours you have used. But in the long run, both fixed and variable cost can be changeable, and it can be changed even in the short term also. Even in the short term, because of the government policy, because of the elections, now you can see, because of many things, these can be changed. Even the fixed cost remain constant, it is not the case. However, in certain level, the fixed cost items may change. Additionally, it assumes that variable costs are very proportionately, but this may not typically occur in the fixed cost, but this will change in a term where I wanted to improve my productivity. The fixed cost will also be varying at the time. So this is the actual chart where we can discuss the output and quantity. If it is increasing, and my total cost is also increasing, this area, this angle is called angle of incidence. The higher the angle is, the more I am earning the profit. And in the case I'm reaching break-even point at the higher places, it means my price is low, or there could be possibility my cost is up. So I can change my prices here, and I can change my cost here to improve my break-even point also. After my break-even point, I said, after my break-even point until my total revenue is the place is called margin of safety. This place is called margin of safety. So my total cost and total revenue intersect at the break-even point, and after break-even point to fixed cost is my margin of safety. So this is my margin of safety. This is my margin of safety. Is there any problem in this chart? So here is I welcome the questions if you wanted to ask anything.
Any other questions?
Someone is typing. Okay.
Hello, ma'am.
Yes.
Ma'am,
I
if
would like. Uh,
ma'am, if no other questions, then we will conclude the session.
yes, yes, yes.
Yes, thank you so much, ma'am, and all the participants for attending the webinar. Our next webinar on tomorrow at 5 p.m.
Yeah.
I
Thank you
request
so.
all of you to join the session. Thank you.
Thank you. Thank you so much. Thank
Thank
you
you,
for
ma'am.
the.
Thank you. Okay.